The bailout of Credit Suisse has sent shockwaves through the international banking system. In this video, we're going to take a look at the collapse of Credit Suisse, but also what this means for Asia. Aaron here from offshore in Asia. So if you want to move your life, your money, your investments, your business out to Asia, we're the ones to help you make that happen. Now, we were a little bit unsure about whether or not we were going to make a video on this topic. There is already a lot of commentary online about this, but we thought it was appropriate as there are implications for Asia, and Asia is our business. So in this video, we're going to give our opinions on the collapse of Credit Suisse in the Asian context. So Credit Suisse had a large focus on wealth management. A lot of their customers' investments are now a little bit uncertain. So what has happened is the bank has essentially collapsed. It has been taken over by UBS, a deal that was brokered by the Swiss authorities, FINMA and the Swiss National Bank. The pressure was on for Swiss regulators to step in and rescue the bank and maintain confidence in the system, especially after a few days earlier you had the debacle in the US with authorities having to step in and bail out and guarantee the deposits for Silicon Valley Bank and Signature Bank. But what has happened here, which is a bit unusual and has angered a lot of investors, is that shareholders were given preference before bondholders. So normally when a business fails, shareholders are the first ones to take a hit. And the thing about this is when people have invested in bonds, you're loaning money to the business and you're taking an interest rate based on the risk of loaning money to that business, with the belief that your bond will have preference over equity in the event of collapse. So what has happened here is people have invested to the business under a certain set of rules with an appropriate interest rate, and then the regulators have come along and flipped that on its head. So as it turns out, bondholders were never appropriately rewarded for that risk. They should have really received a higher interest rate if they knew that shareholders were going to get preference ahead of them. In recent years, Credit Suisse has been no stranger to scandal. They've been caught up in a lot of things. There was the Mozambique bribery scandal. They failed to clamp down on money laundering. They were caught up with Bulgarian drug traffickers. But despite that, people failed to divest. They trusted the name brand of Switzerland, being known for banking, and Credit Suisse as a major international investment bank that has been around for a long time. All of this despite having a poor recent record in risk management. Many investors trusted the name brand regardless, and that turned out to be a big mistake. Okay, so has Switzerland lost its edge as a go-to place for international banking? Well, maybe it has. The Credit Suisse collapse certainly is damaging to Switzerland's reputation as an international finance center. Banking in Switzerland is a lot less private than it used to be. It used to be known as a safe haven for privacy. That has been diminished a lot over the years. There's been a lot of pressure on Switzerland by countries like the US and others with the rollout of FATCA and the Common Reporting Standard on overseas bank accounts. Switzerland has long been regarded as a neutral country, but you could argue they're not as neutral as they once were. They always held out from joining the EU and of course joining the common euro currency. They have a long history of not participating in wars and not taking sides. But recently they did come under a lot of pressure to sanction Russia, and they did lay sanctions on Russia, so perhaps they're not quite as neutral as they used to be. Although you can't extrapolate this out to the whole Swiss banking system, they still do have a lot of good, more conservative banks that are favoured by depositors. You still have to be concerned about what this means for the greater financial system, particularly in Europe. And authorities, of course, have said that the situation is contained, but you have to remember here that they also said that Credit Suisse was in sound financial shape, while at the same time, behind closed doors, they were engineering a rescue package. So make of that what you will. Right, so what are the implications for the Swiss brand of global banking? And there are many. Switzerland is one of the largest financial centers in the world. It has about 2.6 trillion of international money managed there. Well, there is definitely some loss of confidence in the overall banking system. It brings into question the corporate governance in Switzerland banks and also the risk management that has been lacking there. There is a big loss of confidence in the regulators and the established rules by which people invest. Credibility has been lost by putting bondholders ahead of shareholders. AT1 bondholders were written down to zero, while shareholders were bailed out to the tune of 3.2 billion. keeping in mind that shareholders normally rank below bondholders in the event of a collapse. The takeover deal was hashed out behind closed doors, very privately, without the approval of shareholders. That is highly irregular as well. No matter how the Swiss authorities and the regulators try to dress this up, it's clear that the damage has been done. And the fact is that people who have money, who might have had money in Switzerland, they're going to be looking to other places now. So where is the smart money going to flow? Well, there's a few contenders. You've got Luxembourg, Dubai is worth looking at. That's popular, people who are looking to get their money out of the West. If you're wanting to look further east, then of course you have to look at Singapore. Now, in some ways, Singapore can be seen as the Switzerland of Asia. It's a growing global financial hub, and it really does have a strong future ahead of it. It has a strong economy, it's got stable politics, and it is relatively neutral when it comes to geopolitics. It has 3 banks that are ranked in the world's top 20 safest banks. And that's pretty impressive for such a small country. And they are DBS, OCBC, and UOB. Singapore has some of the best private vaults in the world. If you want to vault your gold or silver, you really got to come out here and take a look at some of the vaults they have. They are fantastic. If you want to store your bullion on this side of the world, you can't go past Singapore. There is a thriving family office industry here. A lot of wealthy families, a lot of billionaires from around the world are moving their money out here and their investments out here. This is where the smart money is flowing, so that can't be ignored. Singapore has fantastic access to the rest of Asia. You've got China, of course, you've got Japan, Korea, and then all of Southeast Asia. There is a lot going on out here, a lot of growth, really favorable demographics in a lot of these up and coming countries. There really is a solid future ahead for Asia. And of course, Singapore has quite a favorable tax regime. So there is no capital gains tax when you sell securities here. There is also no dividends tax in the hands of shareholders. Profits are only taxed at the company level, not at shareholder level. So just by moving your investments out to maybe an investment company in Singapore, which has access to all of Asia, you can potentially save a lot of money by not paying your CGT and your dividends tax. Now, of course, this is not advice, guys. Everyone has a different situation. Whether Singapore is for you or not for you depends on you. You should seek out a consultation for that. We can help with that if you like. But the fact of the matter is, it is a viable alternative and potentially has a stronger future than Europe. It's also worth making a quick mention of Hong Kong here. Of course, Hong Kong is a lot closer to China than it used to be. That could be seen as a good thing or a bad thing. But it's also important to note that in recent times, particularly since the pandemic with heavy lockdowns in China, a lot of expats have been moving themselves and their money out of Hong Kong into Singapore. That is a fact. You can make a strong argument here to say that Singapore is in the best part of the world as far as the future for global finance goes. It's got close proximity to China, which is on its way to becoming the largest economy in the world, but it is still very independent from China and very open to the West. For a long time on the world stage, it has been giving Switzerland a run for its money, and with what's happened now with the collapse of Credit Suisse and how the regulators have handled that, this could tilt things further towards the favor of Singapore as being a global hub for international finance. And the best thing is, you don't have to be a global finance titan to participate in the rise of Singapore and Asia in general. Anyone can go there and open up a gold vault. You can go there, open a bank account, you can open a brokerage account, and store your money offshore, get some asset protection, and just hedge your bets a little bit by getting 1 foot out of the West. Anyway, that's it for the video, guys. I hope I was able to add something to the broader conversation around this whole collapse of Credit Suisse. If you want to learn more about us, you can head over to offshoreinAsia.com. We have a lot of free information there that might be of help.